So Douglas, as an investment specialist with Platinum, really what you're looking for is individual companies that are likely to do well and are mispriced by the market.
Yeah.
What are the companies that you think in your portfolio represent exceptional value?
Yeah, well, one of the companies probably surprised people, but Samsung Electronics. So you've probably all seen the exploding telephones. It's quite confronting every time. I fly regularly, so every time I'm at the airport, there's please hand in your Samsung. Samsung is a company that we have owned since 1997. So that's 19 years we've had it in the portfolio. It's gone up about 40 times since we first invested in the company.
So that's not a 40% return.
That's not 40%, that's 4,000% return. It's a company that is our largest holding in the world today. But it's not just about one smartphone that it explodes, if you like. Samsung is a company that's very deep. It's the leading company in display, so televisions and panels. It's the leading company in memory, and it is the leading company in smartphones, but they only make up about 40% of the company's profits. So even in a disastrous scenario after this one product launch, even if you're to take 50% from the profits of the smartphone business, you're only reducing the overall group profits by about 20%. And we don't think that's likely to happen, but that's a bad scenario. The flip side of that is that Samsung has about $60 billion of cash on its balance sheet. It has a market value of just over $200 billion, and it probably earns $25 billion US a year. So it's on a PE of about 6 or 7 times if you adjust for its cash. The average company in the US market today is probably on 21, 22 times. So you're buying one of the best companies in the world for 1/3 of the price of the average US company. And I would say that's a particularly interesting way to look at things.
You've got another theme, which is being underweight to US companies.
Yeah.
And there is a perception, I think, that some companies in China and India that are in a similar space to US competitors are not as good.
Yeah.
You would argue that that's not the case.
Yes, I think the perception is, we talk about the Great Firewall of China. I think everyone assumes that the Chinese would love to have Facebook and YouTube and Twitter and all these things, but we prefer to look at what they actually do have, which is, WeChat and Youku Tudu is like their YouTube, and they've got Sina Weibo. Weibo's the Twitter of China, Baidu's the Google, etc. So we're kind of Western, we're characterizing them as our own businesses. But WeChat, which is owned by Tencent, is an incredible business. 1/3 of the time spent in China on the internet is on WeChat. That works out to being about 700 million people spending 1 hour a day on WeChat. So there isn't a business like that in the West, and the other.
And WeChat is more like a network, isn't it? There's all sorts of internal business opportunities even within WeChat. Is that right?
Yeah. So business. So it's kind of characterized as Facebook, but it's really Facebook and Messenger and all sorts of things added together. And importantly, back to the original point about waiting for the Chinese to copy us, Facebook are now copying some of the things that WeChat's done. For example, trying to pay using the Messenger application. So it's an incredibly powerful tool. And I think the key thing that people miss is that China has really gone straight to mobile. So people didn't buy desktop computers, they bought a smartphone. They've installed WeChat, that's their online identity, and that's where they spend their time. And so WeChat is optimized for mobile, whereas Facebook, which is really a guy in Harvard who couldn't pick up girls, he was trying to find a way to meet girls on the internet. That was done in the desktop world. That was a guy hiding in a room, and that's the way it evolved. So when Facebook went to mobile, it's quite clunky, and the user experience with Facebook has tended to go in fits and starts as they've tried to roll things out. So we think China's a long way ahead in certain areas. They're a long way ahead in e-commerce as a proportion of retail, probably twice what they are in the US as well. So you're really looking at vast businesses, and they don't really need to come head to head. So there's the English-speaking world using Googles and Facebooks, there's the Chinese world, and then other non-English speaking opportunities for them as well. But if you think of things like emojis, in a world or in a country where you use characters rather than letters, then the adoption of emojis was far wider spread at an earlier time as well. And they use they express all sorts of emotions through these, which we haven't really got to yet as well. So
the experience for some US and other international businesses in China is that there's a thriving ecosystem that sometimes they can't compete in.
Yep.
So I think the Uber experience in packing up and going home and selling their business in China is a good example of that. How did you see that playing out?
Well, we have a stake in Didi, which is the competitor via Tencent. Tencent owns a little bit of Didi, but I think the important thing was Uber approached it again from a Western perspective. And I think the anecdote is they were using Google Maps, but Google themselves are pretty low player in China. So they were using an old mapping system, and they never really got the adoption that Didi did. If you think about it from an Australian perspective, it's very hard for foreign companies to compete here because we have, you could argue, protected oligopolies or however you want to describe them, but it's rare that foreign entrants come in and make a success. It's also rare that companies go overseas and make a success of it as well. So in our industry, a lot of fund managers say, oh, well, we own American companies to get exposure to China. We just think that's wrong. We think you want to own the Chinese companies that make the products that the Chinese people want to consume, and they don't suffer the same problems foreigners do when they enter the market. So we own companies across alcohol, sportswear, we own the local telecom company, we own utilities. Our Chinese exposure is Chinese companies for Chinese people, and it's a very, very large domestic market. It's the largest economy in the world, so we're excited about it.
One of the reasons, though, that there's a preference for a multinational exposure is because you've got better corporate governance if you've got a company listed in the US that operates in China. What would be your response to that in terms of investing directly into an Indian company, a Korean company, a Chinese company?
Yeah, I mean, corporate governance is different in different parts of the world. You could look at some of the American companies and argue they pay their executives far too much, and that's pretty poor corporate governance. I mean, at the end of the day, a CEO is only an administrator on behalf of the shareholders, and we would argue that CEO pay has become ridiculous. And you look at the gap between CEOs and what they pay their staff, and it really is something we would question. So you got to be a bit careful saying that American corporate governance is fantastic, but the discounts. I mentioned Samsung Electronics earlier. Samsung trades at 1/3 of the price of American companies, and that's with earnings that may be after poor corporate governance. So you can't put another discount on them after perhaps things have been happened on along the way. We think the multinational story really is just a marketing story. We think it's a lot of fund managers are unwilling to look at stocks in China, or probably don't have the capability in most cases, and therefore it becomes a convenient story to tell investors. But you really got to ask the question, why would you pay twice as much for a foreign company with a small amount of exposure to China as you'd pay for a local company with 100% exposure to that growth? And that doesn't make any sense to us at all.
Well, it sounds like there's still a wealth of opportunities and things that are good for investors to be making money on, even in a challenging environment. So thanks for spending time with us.
It's great, thank you.